please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, welcome back. So the market is actually absolutely flat. The story at the bottom of the screen about money coming back, which Lata pointed out. I mean, I think this is sure to raise. I don't want to maybe exaggerate, but cause a bit of a political firestorm. What was the exercise? What was the meaning behind the entire exercise of demonetization? Do we have actual, now that the notes have been counted according to the RBI, do we have actual evidence that, well, if all the money came back, then, well, where was the black money? And those kind of things. I mean, this is as much a economy-related subject as it has become a political sort of talking point, and a point on which we've seen big debates over the last 2 years or so. Okay, we'll sort of keep tracking that story, getting your reactions. Ashwani Gujral is joining us right now. For now, Ashwani, thanks very much. Morning. So 4-point change, absolutely flat. Would you imagine that maybe here, gradually during the course of the day, we see some profit taking, or the fact that the market is actually holding on gives you indication that it may go the other side? It may continue to go higher.
Well, on the currency, the good news is that more did not come back than was in circulation, because that was the fear. Having said that, today is a consolidation type of day, low volume, that sort of action. But overall, I don't think on the index there is much to do now. There was a trade in the morning where Bank Nifty gapped down and then had a 100-point move. That's done. But overall, it's more positive than negative. There's individual sectors like realty, PSU banks, metals, which are doing well. But overall, it does not look like the market plans to make a large move. Having said that, future consumer is a buy with a stop of 50. Target of 56. JSPL is a buy with a stop of 216, target of 228. And Capital First is a buy with a stop of 645, target of 670.
Okay, Ashwani, I just want to talk to you about BHEL. I'm just looking at the way the stock has moved, and it's moved quite a bit. I mean, not just today, last 2-3 weeks. I don't know if this is some buyback hope or what hope that's getting people so excited about BHEL. Look at that, 6% days high. Let's pull up a longer chart. Let's pull up a 1 year. After being in the doldrums for almost sort of 11 months, suddenly in August, there's interest in BHEL that's built up, and that's what I'm talking about. Your thoughts, Ashwani?
The high here was 390. If, 50 becomes 70, I don't think that's a big deal. And, it's clear what kind of results they come out with every time. So it's heading towards its 200-day moving average around 85. There are some stocks which are moving higher, but basically these are all pullbacks. So my sense is it's best avoided. I think right now metals is a space that you should be focusing on. So focus where you are getting new highs like JSW Steel, etc., or even the corporate banks. These sort of, 1 day off, 1 day on type moves, they generally tend to end suddenly.
Index, as we've been telling you, not much moving. 2 points lower on the Nifty, 1 point up on the Sensex. That's the kind of absolute range-bound day that you've got. Yes Bank is interesting because after sort of struggling for the last several sessions, we still don't have the final clarity on Mr. Rana Kapoor's continuation. That's expected to come in by Friday. After that struggle, today is a day when buyers are back on Yes Bank, and that stock is moving to the highs of the day, about 2% on the higher side. So that's one stock, but otherwise, Prashant, absolutely quiet on the market. I mean, the indices have decided to, I think, take that midweek break, so to speak.
Oh, I think well warranted, right, Surbhi? Because, I mean, for the week, we are up 1.5%, and this is just Wednesday. And we've got, 2 more days to go, 2.5 more days to go. So we'll see. But for now, the rupee...
That's not a comforting picture on the rupee. The pace of the decline, I mean, that's what we always say, right? The RBI is not targeting any particular levels. As long as it's orderly and there's sort of no knee-jerk move in the market. But this is quite rapid. I mean, we're talking over 0.5% already.
Yeah, it's a big one.
Yeah.
I mean, but this, I think, is, as has been the case, a combination of both dollar strength and emerging market currency weakness as well. There's nothing specifically happening here in India like it's happening with other currencies. So with regards to India, it would probably be more to do with the dollar than specific idiosyncratic kind of factors which we've seen in other currencies. Manishi Ray Chaudhary is Asian equity strategist, sort of equity cash Asia Pacific at BNP Paribas. He's with us right now. It's a good point to get him into the conversation. Manishi, thanks very much. Let's just begin with the big call coming in from you, which is BNP is downgrading India. Tell us what that means. Is in the Asian portfolio, why are you doing that? Just run us through the headlines.
Well, I wouldn't use the present continuous tense. I would say we downgraded India. That was about a month ago. And, from all the indications of late, we have gone wrong on that. So let me give you the context of this. Around the beginning of this year, in fact, late 2017, we fixed a target of 37,500 on the Sensex from pure fundamental considerations pertaining to earnings growth and target valuations. It appeared aggressive at that point of time because Sensex was close to 33,000. Now, having said this, the market has actually zoomed past that target. And about a month ago, when we downgraded India to a neutral, the market was actually hovering around our target. It was pretty close, within striking distance. So there were two reasons. Number one, the market had already reached our target. Number two, we anticipated the weakness in the currency, which was already brewing at that point of time as a consequence of the oil price moving up strongly and the generalized dollar strength that we've seen versus all emerging market currencies. We were also concerned about the earnings environment because over past few quarters, we have been consistently seeing earnings downgrades to consensus earnings on India. What we did not anticipate and what has really played out over past 5 to 6 weeks, I would think, is that the US-China trade friction has possibly strengthened and escalated way beyond what we expected. And as a consequence, India is perceived to be a safe haven by investors in this region. As a consequence, we have seen foreign institutional flows also turning back positive both in July and August. And when added to the consistent and steady domestic inflows, they have sort of added fuel to the fire, leading to India being the best performing market in this year. That is really the background, and those are the reasons why we downgraded. For the time being, we're not making any change to our stance. I think investors would have to be cautious. They will have to be stock specific, when it comes to investing in India. Now, having said that, one silver lining is that the most recent result season, which literally concluded about a week ago, has turned out to be better than the past several. And that pertains to both the consumption universe and, to a limited extent, the investment universe as well. That is, the background from my side.
But having said that, Manishi, a lot of the India bulls now seem to be citing reasonably okay start to the earnings sort of trajectory for this year. There are, again, believers who feel that the worst of the PSU bank stress, the corporate bank stress is over. And if anything, losses should reduce because there's expectation and hope of some recovery as well, some money coming back from the NCLT process. So, on the earnings valuation argument, where do you stand at the moment?
Okay. On the earnings valuation argument, we think that over the next couple of years, India would possibly see mid-teens to high-teens kind of growth. When I look at the consensus EPS growth forecast for this year, fiscal 19, it kind of makes me slightly cautious because it seems that it's still slightly above what can be realized this year. I think it's close to about 20% or so, both for fiscal 19 and fiscal 20. I think it'll possibly settle at somewhere around the early to mid-teens for this year. Now, having said this, the point that you made about the earnings environment in general having improved, I would tend to agree with that. When I look at the most recently concluded earnings season, I think both consumer-orientated companies, they have come up with strong commentary on their earnings. They have had margin expansion, and particularly their business and revenue growth in the rural side seems to be doing well. which basically indicates that there is a possibility of pricing power coming back. When you look at some of the macro indicators, there's been a bit of a convergence between WPI and CPI, which is a classic lead indicator of corporate pricing power coming back in, as far as the consumer sectors are concerned. On the investment side, we have not really seen major positive surprises, but if you look at the order backlogs and order books, they are beginning to show an uptick. If you look at the macro indicators like RBI's Ubicus survey, that also seemed to have moved up, indicating that average capacity utilization has been increasing. So these are the positive signs, and I would tend to agree with, with the conclusion that the worst of the bank's NPLs, the non-performing loans, are possibly behind us. It's a consequence of the regulatory changes that the Reserve Bank of India effected in February. And, at some point of time, investors may have to dip their toes into that universe, though, in our model portfolio or in our stock selection, as far as India is concerned, we are still sticking to the private sector banks.
Manishi, welcome back. I mean, it looks like you may be on the verge of changing your stance. You began by saying we downgraded India a month ago. We've been wrong so far, but we're not changing our stance. But then, you said all these other things. You said results have been better than the previous many quarters of results. Worst of NPA stress could be behind us. So what does this add up to? Because markets are moving higher. There is also this entire thing about the importance of reliance and what that may do, right? I mean, funds are still underweight broadly. I mean, I'm talking about local funds and actually even foreign funds. Relative to RIL's weight in the index, most funds are underweight. And that has been the single biggest contributor to this move in 2018 so far. So just tell us where you stand.
Yep. Okay. So coming back to your original question, that, what would force us to change our stance? If I were to answer that question, I think two things. First, I think the performance of the stocks in India needs to get a little more broad-based. Since when we see signs of that happening, it would possibly enthuse us a little more about this market. Now, I think that's beginning to happen over the last 1 or 2 weeks. But broadly, if you look at this year's rally, it has been extremely concentrated in quite just a few names. Maybe just top 10 or 15 stocks in the market have led the Sensex or Nifty or the broader indices where they are today. Second, as you pointed out, that investors are possibly underweight some of the leading names in this market. We tend to look at it on a broad market basis, and on that consideration, FIIs, both global emerging market investors and Asia ex-Japan investors, still have an overweight on India. Now, that overweight has obviously declined slightly over the past 3 years or so, but they still have about somewhere around 1.5% to 2% overweight. Now, there's one very interesting trend that we have noticed. If you look at last maybe 3 years and last 3 months, over the past 3 years, investors' weight on China has actually increased. But over the last 3 months, it has declined. Exactly the opposite has happened in India. Over the past 3 years, right from, let's say, mid to late 2015, investors actually reduced their overweight tilt on India. But over the past 3 to 4 months, they have been increasing it again. I think it tells us a story that investors are possibly consciously trying to move away from North Asia, which is perceived as, kind of in the eye of the storm as far as this US-China trade friction is concerned. And they're trying to reallocate towards markets which are felt to be safe havens, and India is clearly one of them. India also has the advantage that it offers a broad choice of various different sectors, which don't always move in unison, and therefore offers investors a pretty wide array of diversified sector choices. So, I think, India has its advantages and disadvantages. On the risks and the so-called disadvantage, that side, I would clearly mention the premium valuation that it trades at, and that has even expanded even further. So, as I said, there are 2 indicators that I would look at: broad basing of the market rally, a slightly broader degree of participation, and earnings estimates beginning to move up, which hasn't happened over last 1.5 to 2 years.
Manishi, finally, what are you most negative on in this market in terms of themes or sectors? And relatively, I mean, within your overall downgrade call, what is it that still interests you in the Indian market?
Okay. So we quite like the consumer and consumer discretionary space, including autos. We have a pretty significant weight on the Indian autos. Also, some of the other Indian consumer names which are beneficiaries of rural upturn, rural income upturn. I would also name some of the select few engineering or industrial names, particularly the ones which are broad-based and operate across a wide array of infrastructure construction. I would also talk about some of the refiners, you know, the broad oil space, but in particular the refiners and chemicals there. I would also say, you know, the IT services. The Indian IT services are a clear beneficiary of US dollar revenues. So I think these are the three or four different sectors that we're quite significantly positive on. Apart from, you know, some kind of an evergreen exposure that we have had, which are the private sector banks, and in particular those which are retail lending focused.
Manishi, thanks very much. Appreciate you joining in and sort of sharing your thoughts with us, and we will have you back soon again, and maybe with a different opinion on India. But Manishi's point is well taken. He says the rally really needs to get broader. I mean, and not just limited to, not just even 10 stocks. I mean, the Nifty, if you just look at the Nifty, it's maybe 5 or 6 stocks. That's it, which is...
Let's just move to some stories that we are getting in from the capital. And this is important from the taxation point of view. The Central Board of Direct Taxes has made its stance clear on the STT matter. That's the levy of securities transaction tax on F&O trades, which will eventually go on and get physically settled. Timsi Jaipuria is joining in to clarify this to us and give us the details. Timsi.
Well, as you rightly mentioned, CBDT has directed IT department in Mumbai to file an affidavit before the Bombay High Court on the STT matter, where CBDT wants that its stance should be very clear with the court that the STT shall be applicable on delivery-based derivative transactions. CBDT's stance is also that derivative contracts being settled by physical delivery of shares is not different from other share transactions. Thus, CBDT says that STT as applicable to delivery-based equity trading shall also apply to derivative transactions which end in delivery itself. So CBDT has stated very clearly that the legal mandate of STT is wide enough to cover these transactions. Remember, NSE in April 2018 had listed 46 stocks whose derivative contracts would result in physical delivery of shares. And just to give a background to what the matter is, the ANMI, which is a representing body of brokers, had filed a petition against NSE and SEBI regarding the STT matter. ANMI stand for, if you remember, its plea was very clear against NSE that the decision to levy STT at 0.1% on derivative contracts of stocks that are physically settled. So Bombay High Court had then directed CBDT to make its stand clear, and now finally CBDT has replied to the IT department in Mumbai to make it stand clear that when it comes to derivative-based transactions, STT shall be applicable on delivery-based of derivative transactions. Back to you.